Last week, famed investor Stanley Druckenmiller warned, quote, "There's a lot more bodies coming," as 11 years of zero interest rate policy run into reality. As he put it, quote, "When you have free money, people do stupid things. When you have free money for 11 years, people do really stupid things." The really stupid things in question are some of what I've talked about these past few videos: crap companies and major real estate projects that only made sense when investment money was essentially free. Meaning we are now seeing a mass extinction now that money is very much not free thanks to the Fed rate hikes. In fact, the prime rate, that's the interest rate offered to the very best companies, is currently running 8.25%. That is up from 3.25% for most of the past 15 years. In other words, we have an economy that has grown into cheap money, and that cheap money is over. All with the added bonus that many of America's cities, so 85% of Americans live in cities or suburbs, are so badly run between crime, quality of life, and regulatory and tax harassment that companies are either fleeing or they are closing up shop altogether. All of this while post-COVID remote work means millions of workers also no longer need to suffer the newly miserable cities, so they too are fleeing. I've got a Substack going through this cycle, and it amounts to a perfect storm for commercial real estate that, if anything, is getting worse. I've mentioned that these storms haven't even begun to hit the banks. So far, it's mainly been melting government bonds taking out banks one by one, as in they've got assets paying 2 or 2.5%, while their debt is costing closer to 5%. But in fact, about 43% of regional bank loans are in commercial real estate. That's what they specialize in, since they know the local area, with 40% of that in office space. So both are directly in the crosshairs. Taken together, we get a death sentence for regional banks that, given the scale of the bubble, could spread across the entire financial system as higher rates kill the businesses, they stop paying rent, and the real estate goes under, with additional stresses from consumer defaults. I've mentioned recently Americans are now buying groceries on installment, and even a potential wave of mortgage defaults, given homebuyers have been flooding into the same variable rate mortgages that mass defaulted in 2008. Now, Druckenmiller wrapped up saying, quote, "I don't want to see headlines that I said something worse than 2008 is coming, but I think it's naive not to be open-minded to some sort of possibility of that effect. In other words, it's looking like 2008, but I really don't want to say that out loud." Now, the 2008 crisis was the unwinding of a 2.5-year experiment of the Fed manipulating interest rates too low. In fact, rates averaged 1.25%. That inflated an asset and bad credit bubble that, when it popped, nearly took down the entire financial system. What we're facing today is on a whole nother scale. We're looking at 11 years of rates that averaged 0.1%, which inflated a bubble that, when it did pop together with the COVID lockdowns, they poured another couple of years zero interest rates on top of it. Industrial scale gasoline on the fire. Pundits on the way up called it the everything bubble, and when it pops, it could well be the everything collapse that could take out even the good companies and the jobs they provided. Okay, we'll be watching. See you next time.